Ever wonder what stocks Congress is buying? We're diving into the recent moves straight from Capitol Hill. Because if there's one thing we know, it's that politicians seem to have a knack for timing the market just right. Want to know what they're loading up on and whether you should follow the money? Stick around because some of these picks might surprise you. We're trying something a little different than stock teasers today. I thought it would be fun to look at some recent stock picks made by members of Congress. The first stock we're going to look at is Simon Property, which was purchased by Victoria Spartz, a Republican. Simon Property Group is the largest retail real estate investment trust REIT in the U.S., specializing in owning, managing, and developing malls, premium outlets, and lifestyle centers. Its portfolio includes high-end shopping destinations like the Forum Shops at Caesars and premium outlet malls worldwide. The company generates revenue from rental income, tenant services, and retail partnerships. I personally think this stock is a hold, and here's why. First is economic recovery, but still cautious. While the economy is showing signs of recovery, there's still caution around consumer spending and the full return to physical retail, which could impact SPG's revenue growth. Second is interest rate roller coaster. With interest rates fluctuating, SPG faces increased borrowing costs, which might put pressure on their financials, especially if they need to refinance debt or fund new projects. Third is dividend growth slows down. SPG has a history of increasing dividends, but recent growth has been modest, suggesting a more conservative approach to shareholder returns amidst uncertain retail demand. Fourth is malls in transition, adaptation or outdated. As malls evolve from traditional retail to mixed-use spaces, there's uncertainty about how effectively SPG can adapt its properties to meet new consumer behaviors and needs. Fifth is occupancy rates, up but not out of the woods. Although occupancy rates have improved, they are still below pre-pandemic levels in some areas, indicating that the full recovery of foot traffic and tenant stability isn't guaranteed. AbbVie was recently bought by Jared Masokowitz, a Democrat from Florida. AbbVie is a global biopharmaceutical company focused on developing and manufacturing innovative therapies. Its key areas include immunology, oncology, neuroscience, and aesthetics. Known for blockbuster drugs like Humira, Skyrizi, and Rinvoq, AbbVie generates substantial revenue from its diversified portfolio and pipeline of new treatments. I think AbbVie is a buy, and here's why. First is Humira's heirs, Skyrizi and Rinvoq on the rise. AbbVie's new immunology stars, Skyrizi and Rinvoq, are rapidly gaining market share and show potential to exceed Humira's peak sales, which is crucial as Humira faces biosimilar competition. Second is Dividend King status, a royal cash flow. With over 50 years of consecutive dividend increases, AbbVie offers a compelling yield around 3.6%, making it a magnet for income investors. Third is post-patent power, diversified drug dominance. Beyond Humira, AbbVie boasts a broad portfolio including oncology and neuroscience drugs that are driving growth, ensuring the company isn't overly reliant on one product. Fourth is pipeline promise, innovation on the horizon. AbbVie's robust pipeline, with numerous Phase 3 studies and recent acquisitions, suggests a future of new treatments, potentially leading to significant revenue growth. Moskowitz also bought McKesson Corp, and the ticker is MCK. McKesson Corporation is one of the largest healthcare supply chain companies in the world. It distributes pharmaceuticals, medical supplies, and technology solutions to healthcare providers. McKesson plays a critical role in the U.S. healthcare system, ensuring the efficient delivery of medications and services to hospitals, pharmacies, and clinics. The company is also expanding its focus on oncology and biopharma services, while leveraging technology to improve healthcare outcomes. Its scale and strategic partnerships give it a competitive advantage in a highly regulated industry. I think this stock is a buy, and here's why. First is growth engine fired up by strategic acquisitions. McKesson has been expanding its reach through strategic acquisitions like Prism Vision, which bolsters its specialty care offerings and positions it for long-term growth in the healthcare sector. Second is solid performance despite market challenges. Even with some misses on earnings, McKesson raised its full-year EPS guidance, showing resilience and adaptability in a volatile market with a 19% increase in U.S. pharma sales last quarter. Third is a dividend aristocrat in the making. McKesson has been consistently increasing its dividends, with a recent 15% hike, demonstrating a commitment to shareholder returns and financial stability. Fourth is market dominance in pharmaceutical distribution. With a significant market share in drug distribution, McKesson benefits from scale, offering pricing leverage and cost efficiencies, making it a dominant player in a highly consolidated market. Fifth is analysts are bullish with a bright forecast. Analysts are giving McKesson a buy recommendation with an average price target suggesting substantial upside potential, reflecting confidence in the company's future performance. I'm going to reveal the rest of the stocks in about 20 seconds, but before I do that, I want to remind you to click the link in the description to check out AlphaPicks. I reviewed over 100 stock picking services, and AlphaPicks performs the best and actually beats the market easily. If you click the link in the description, you get $50 off AlphaPicks. So go ahead and click that link and take advantage of this amazing deal. Now let's shift to Republican Byron Donalds' recent stock picks. He made two trades, and the first is First Citizens Bank shares, and the ticker is FCNCA. First Citizens Bank is a U.S. regional bank known for its conservative management and steady growth. Headquartered in Raleigh, North Carolina, it offers a range of services, including personal and commercial banking, wealth management, and lending solutions. The bank gained attention after acquiring several troubled institutions, including the collapsed Silicon Valley Bank. Its strategic acquisitions have significantly expanded its asset base and geographic footprint, making it one of the largest family-controlled banks in the country. This is another stock I think is a buy, and here's why. First is Silicon Valley Bank acquisition, a game changer. First Citizens' acquisition of Silicon Valley Bank has significantly expanded its footprint and capabilities in the tech and innovation sector, offering new growth avenues and stabilizing its position in the market. Second is consistent performance in uncertain times. Despite economic fluctuations, First Citizens has shown consistent performance, with its stock price increasing by over 142% in the last 3 years, outperforming many of its peers in the banking sector. Third is strong leadership with a family touch. Led by the Holding family for 3 generations, First Citizens benefits from long-term strategic thinking and stability, which has been key during the bank's rapid growth and integration of new businesses. Fourth is dividend growth that keeps giving. The bank has a history of buying back shares and increasing dividends, with a recent $3.5 billion share buyback program announced, indicating confidence in its financial health and future earnings potential. Fifth is a well-rounded financial giant. With over 500 branches across 23 states and assets exceeding $200 billion, First Citizens Bancshares has cemented its status as a major player in the U.S. financial landscape, offering comprehensive services from retail to commercial banking. The second stock bought by Donalds was GoDaddy, and the ticker is GDDY. GoDaddy is a leading internet services company specializing in domain registration, web hosting, and website building solutions for small businesses and individuals. Headquartered in Arizona, it serves millions of customers worldwide, helping them establish and grow their online presence. GoDaddy offers tools for website creation, e-commerce, digital marketing, and business management. Known for its user-friendly platform and strong customer support, GoDaddy continues to expand its services into managed hosting and security solutions to cater to evolving online business needs. GoDaddy is a borderline buy in my opinion, and here's why. First is Momentum Magic, GDDY's strong momentum score. GoDaddy has been showing strong momentum, with shares up significantly over the past year, and a momentum-style score of B, making it a stock that's riding a positive trend. Second is earnings estimates on the up, analyst optimism. Analysts have been revising their earnings estimates upwards for GoDaddy, with the Zacks consensus estimate increasing, which typically signals confidence in the company's future performance. Third is Cash Flow King, robust cash flow growth. GoDaddy's year-over-year cash flow growth is impressive, outpacing many of its peers, which can be a sign of financial health and operational efficiency. Fourth is Customer Retention Champion, high retention rates. With a customer retention rate of about 85% and even higher for long-term users, GoDaddy shows loyalty among its user base, which supports stable revenue streams. Fifth is Global Growth Game, expanding international presence. GoDaddy isn't just a domestic player. Almost half of its customers are international, showing a broadening market reach which could drive further growth. Now let's look at some recent buys from Democrat Josh Gottheimer. He's been buying a lot of stocks lately, and one of them is 3M. 3M is a diversified global conglomerate known for its innovation in industrial, consumer, and healthcare products. Headquartered in Minnesota, the company produces thousands of products across categories like adhesives, abrasives, personal protective equipment, and healthcare solutions. Its well-known brands include Post-it notes, Scotch tape, and N95 respirators. 3M has a strong focus on research and development, driving advancements in materials science. The company's global reach and broad product portfolio make it a key player in multiple industries, though it faces ongoing challenges related to legal liabilities and environmental issues. I think 3M is a buy, and here's why. First is the turnaround tale. 3M's comeback story just began. 3M has shown substantial signs of recovery in 2025, with its stock rallying 18% in January after beating Q4 earnings estimates, signaling the potential end to post-pandemic struggles. Second is Innovation Station. 3M's R&D is paying off. The company's focus on innovation is evident with new product launches in the transportation and electronics segment, driving market traction and potentially future growth. Third is legal headwinds cleared. Settlements open new horizons. By resolving major legal issues in 2024, including earplug and PFAS lawsuits, 3M has cleared significant uncertainties, allowing for a clearer path towards profitability and growth. Fourth is Dividend King status, a dividend for the ages. As a dividend king with over half a century of consecutive dividend increases, 3M offers investors a historically high yield, currently around 2.79%, providing a steady income stream. Fifth is under the radar value. MMM stock is priced to buy. Despite a sharp rally, analysts still see 3M as undervalued, with a forward PE ratio slightly above its 10-year average, but with expectations for continued earnings growth, making it a potentially lucrative buy at current levels. Another stock Gottheimer bought is Abbott Laboratories, ticker ABT. Abbott Laboratories is a global healthcare company headquartered in Abbott Park, Illinois. Founded in 1888, it specializes in medical devices, diagnostics, nutrition products, and branded generic medicines. With approximately 114,000 employees, Abbott operates in over 160 countries. In 2024, the company reported sales of $42 billion. I'd personally pass on Abbott, and here's why. First is legal landmines, baby formula lawsuits, and recall fallout. Abbott faces ongoing legal risks from its 2022 baby formula recall, including a $495 million settlement for a premature infant's injury and dozens of pending lawsuits. These issues could drain cash reserves and damage brand trust long term. Second is CGM wars. Dexcom's shadow looms large. While Abbott's Freestyle Libre dominates the continuous glucose monitoring (CGM) market, rival Dexcom is aggressively innovating. With only approximately 6 million users served globally, out of 500 million plus diabetics, Abbott's growth runway isn't risk-free, especially if competitors undercut pricing or win FDA approvals for next-gen devices. Third is post-COVID reality check. Diagnostics decline. Abbott's Q4 2024 diagnostic sales fell 0.6% year-over-year due to plummeting COVID-19 testing demand. While organic growth excluding COVID sounds strong, the segment's reliance on pandemic-era revenue leaves a gap that new products may struggle to fill quickly. Fourth is dividend darling, or overvalued trap. At a PE ratio higher than peers like Johnson & Johnson and a dividend yield of just 1.8%, Abbott's stock trades at a premium. Analysts note its 2025 revenue growth forecast, 6.97%, lags behind the medical device industry average, 9.16%, raising questions about valuation. Fifth is 2025 guidance, strong. But priced in? Despite upbeat 2025 organic sales growth guidance, 7.5 to 8.5%, Abbott's adjusted EPS forecast of $5.05 to $5.25 barely meets analyst expectations of $5.16. With shares already up 7% year over year, there's little room for error, and any R&D delays or regulatory hiccups could trigger a sell-off. And make sure to click the link in the description to check out AlphaPicks. This is the best stock picking service, and clicking the link saves you $50 on this awesome service. So go ahead and check out AlphaPicks now and put yourself in the best position to win with stocks.